So perfect, everyone in the class. Are you all there? Able to see me, hear me? What is the status of audio, video? How is everything? Is everything super set, super fine? Please tell me. Please tell me. So just a second. Are you all there, guys? Is everything set? Come on, live people. Come on, recorded people. What's going on? Yes. So I guess my audio, video, everything has been proper. We are now going to discuss interest rate risk management chapter in full English language. I mean, it is going to be a revision of concept as well as question of this particular chapter, where you are going to understand the things in so detail, solve the questions and understand them with great clarity that will be sufficient enough for you to have a good revision for your exam. Perfect. So just a minute, let me check once something and then we all proceed. Okay. Okay. So wait. 1 second, please. Wait, everyone. So audio video seems to be clear. Yes, it seems to be fine. Sharing my screen, then trying to explain you what's going on. Yes, as usual, as we do in the class, certain basic things about the notes and everything. And yes, then we continue. Perfect. Someone is asking, when can we expect the International Financial Management Marathon? I'll try to do it in the afternoon. I'm not committing it, but I'll try to do it in the afternoon. Done? So come on, people. If not today, then it'll be day after tomorrow. If not today, it'll be day after tomorrow. Boss, what's happening on interest rate risk management? Please look at this. In the study material, this is this chapter called as interest rate risk management. In our outnotes, we have merged the two chapters, derivative and IRRM. Derivative is another video, right? And this video is particularly IRRM. Let me tell you a few things. In this video, we're gonna use some question bank, like a question bank and the concept note. These are the same notes that we provide to all our batch students. These notes are amazingly designed notes where all the concepts are being presented in terms of tables, timelines, charts, graph, and not just boring text. First thing, they are, I mean, complete, comprehensive. They give you crystal clarity about everything. They are perfect, right? Then we gonna also use in this revision video something called as outscanner, which is nothing but our question bank, right? Which has the compilation of all the RTPs, MTPs, exam papers, everything, which means again, beyond this outscanner, you won't be needed to refer to anything. Only the outscanner is sufficient, right? Again, these are the same notes that we refer for our regular etc. batches. This note also has a QR code. You can scan the QR code, look at the video solution of this question as many times whenever you want. That is all there. Fine. Next thing is important for you is that other revision videos are also there similar to this particular chapter. Link of the playlist in the description is there. We are already done with derivative, portfolio, forex. We have planned to come up with advanced capital budgeting, international financial management, mutual fund, and all other chapters we have planned to come up with, right? Someone is saying the video is buffering. Is it the case for everyone? Jay says the video is buffering. Hamu, good morning. Good morning, guys. Is the video buffering? Can someone please confirm? Is it, people? Now, okay. Perfect. Great. So that was all, everyone. So now let's get started. Before getting started, let me tell you this is going to clear all your concepts and make the chapter IRRM confusion free, easy for you. But for that to be achieved, you will have to first make sure that you like this video and subscribe the channel. Yes, so that I can be motivated enough to come up with such more videos. Perfect. Now listen to me. When we talk about interest rate risk management, right, where we are going to learn about interest rate derivatives. These are the derivative contract whose underlying is not a particular asset that we saw here, like gold or a share. The underlying here is an interest rate, which means these contracts will be contracts at like these contracts will be contract to borrow or lend on a future date. Generally the contracts here were about buying or selling on a future date. These contracts are about borrowing or lending on a future date. Yes. So what do we mean to say? We mean to say the four contracts is what you will have to refer, right? Forward rate agreement, interest rate futures, interest rate option, and swaps. These are the four agreements that you'll have to cover. Before going to these particular things, let's learn something in the basics, which is about the fixed versus floating interest rate. Sir, when you go to the bank to take a loan, there are two types of loan that you can take. One is fixed interest rate, another is floating. By fixed interest rate, what do we mean? Fixed interest rate means if you go to the bank to take a loan for 5 years, the rate of interest, for example, the bank says is 10%. Then for the next 5 years, it will continue to remain 10%. It won't change for you based on how the interest rate is changing in the market. Sir, in the market, the interest rates are changing. For example, today we have a different economic scenario. Tomorrow, if the economy has inflation, to cure that inflation, RBI may increase the repo rate. In general, interest rates in the market may increase, but for you, for your loan, the rate continue to remain 10%. Your loan rate will not be affected. Another is variable rate, where the rate at which you take a loan, the rate at which you give the loan is linked to a market rate. For example, the rate of loan is repo by RBI plus 2%, for example. So whatever repo RBI decides for every quarter or every year, whatever the scenario is, that repo for every quarter plus 2% is what you will have to pay as interest, which means in the next 10 years, suppose RBI increase the rate of repo, then the interest that you will have to pay to the bank on your borrowing will also increase. Repo decrease, your rate of interest which you will pay to the bank will also decrease, and that is called as floating interest rate. Can you all feel the risk in floating interest rate, that the cash flow that you are going to pay are uncertain, people in the class? I mean, before we all proceed to learn derivatives, it's very important to understand the need of derivatives. Come on, come on, come on. Everyone, what do you all say? This is not going to be an extended video of 3-4 hours. Hopefully in a time period of 2 to 3 hours, we should be able to do it. Yes. Arpit, hello. Who all do we have? Come on, live people. Very, very good morning. Join in quick. So, what all do we say? Sir, with respect to the floating or the variable interest rate, let's understand the mechanism of how does it work. Sir, for a particular period, for example, if I talk about this particular 6 month, the rate applicable for 6 months, these 6 months get decided at the start of that. For example, today is 1st Jan, that is when the rate applicable from 1st Jan to 30th June gets decided. Since it is a 6-month rate, since it is a 6-month period, the applicable rate is called as 6 month. Say the market reference rate is LIBOR, so it will be called as 6-month LIBOR. Yes. Now, at 0 point, when the rate gets decided is called as fixing date or reset date. The period for which it gets decided is called as reset period, and whatever interest that got decided at 0 point will be paid at the end of the period called as settlement date. So suppose you take a 100 rupee loan here from the bank. Rate of interest is LIBOR plus 1%. For this particular 6-month, LIBOR turns up to be 8. You will have to pay total 9%. But that is a per annum rate of interest. So 100 into 9% into 6 divided by 12 is 4.5 rupee of interest you will pay on 30th of June. The mechanism is really important to understand. Who is sending these hearts? What's happening? Oh my God. Why is the mood so red today? Dhananjay, how is life? All good? Done with power and everything? Yes, people. So come on. Sir, similarly, for the next 6 months, in the start of that period, the LIBOR for the next 6 months get decided, called as 6-month LIBOR. So please understand, when we say 6-month LIBOR, it obviously means it is for a period of 6 months. Every 6 months it gets settled and new rate gets decided. Sir, if it is 3-month LIBOR, it means it is the rate applicable for only those particular 3 months. At the end of every third month, a new rate gets decided. I mean, at the start of every 3 months, the rate gets decided, which gets paid at the end of every 3 months. This is how it is, right? Cool. Now taking you ahead. At 0 point, what is the spot rate in the market that we know? So. Try to link it with the fixed income security. Still, I would try to give you a background. Please listen to me. Just 1 second. Yeah, please listen to me. Perfect. Guys, 11 minutes. Yeah, everything seems to be sorted. Fine. Sorry, everything seems to be sorted. So I was saying at 0 point, we know what will the rate that will prevail for the next 6 months. But similarly, do we know that after 6 months, for the 6 months, what will be the rate that will prevail in the market? No. The rate of interest of a future date, we don't know today. Right? So please understand, there are two types of rates in the market. One is a spot rate, another is forward rate. When you go to the bank to borrow or lend, right, an amount today, so the rate that applies on that lending borrowing is a spot rate. So a spot rate is the rate of interest that applies to a today's lending borrowing. Sir, for different maturity it is different. If you want to borrow for 3-month, rate is different, 6-month rate is different, 9-month, 1 year, 2 year, 5 year, the rates are different. However, similarly, sir, if I want to borrow after 3 months for a period of 3 months, 6 months, 9 months, 12 months, whatever, then what is the rate? On that day when we stand, it is only on that day we will get to know the spot rate of that day. Do you agree? I mean, the LIBOR applicable for the next 6 months, you will get to know only when you reach to 1st July. On 1st Jan, you can't predict. Can you feel the uncertainty regarding it? That what will be the rate in the economy, that I don't know, which is what I am afraid of. That today I know the spot rates, but after 3 months, what will be the spot rates in the economy, that we don't know. Are you all realizing? So to come up with the solution of it, what we have come, we have started creating some agreement called as forward rate agreement, in which what happens at 0 point, we enter into a contract. For example, I wanted to borrow, so I went to the bank saying that what will be the rate after 3 months. He says, I don't know. So I say, today can we enter into a contract where I can borrow after 3 months? Which means, can we fix the rate today only? This rate that decided today, which is applicable to a future lending and borrowing, is called as forward rate. Is called as forward rate, and the agreement that we have entered into, me and the bank, is called as forward rate agreement. So in short, the rate applicable to today's lending borrowing is a spot rate. The rate applicable to a future lending borrowing decided today, agreed upon today, is a forward rate. Sir, both a spot and forward, different maturity, have different rates of interest, right? I will also upload a fixed income security revision video, which is a part of securities valuation, and I would strictly recommend you to watch that. Why? Because it will give you a further next level conceptual clarity, as I specified in the fixed income securities. Yes, so these were the basics regarding the interest rate that we covered. Now I'll take you the next discussion, the first contract, which is forward rate agreement. Real easy. At 0 point, you wanted to suppose borrow and I wanted to lend. I mean, we stand at 0 point, you want to borrow and I want to lend after 3 months for a period of 6 months. From 3 to 9, the lending borrowing is expected to happen. Today, we are afraid that what will be the rate after 3 months. We know the rate of interest today in the spot market. But what will be the rate after 3 months, for 6 months, that no one knows, that is uncertain. To eliminate this uncertainty, we entered into a contract. What is agreed upon? Agreed that you will borrow, I will lend. After 3 months, for a period of 6 months, a notional principal is also decided that how much will be borrow lend, sir 10 lakhs. The rate is also decided at which we will borrow lend 8%. This agreement that you see here is a forward rate agreement, an agreement that has decided a forward rate between us. Sir, which means what will happen? This agreement now eliminates uncertainty. How come? Common sense. At 0 point, we enter into an agreement. Do you agree on a later date now? Whatever be the rate of interest, we don't have to worry. I have agreed upon to lend you. I will lend at the rate of 6%. You have agreed upon to borrow. You will borrow at the rate of 6%. There is no uncertainty. Perfect. Sir, when does the borrowing starts? The borrowing starts here. What is the period of borrowing? Period of borrowing is this time period. When does the borrowing end? The borrowing ends here. Right? Sir, does it the actual borrowing and lending that will take place? The answer is no. Almost in all the interest rate risk management chapter, which means in all the derivatives, interest rate derivatives, the type of settlement will be net settlement. Do you remember I taught it to you in derivatives? In derivatives, I taught to you there are two types of settlement. One is delivery, another is net, which is cash settlement. In the delivery settlement, we do what we agreed upon. For example, 0 point you agreed upon to borrow, I agreed upon to lend. Then at the end of third month, I will actually lend and you will actually borrow 10 lakh rupee. However, in case of net settlement or cash settlement, we don't end up actually borrowing or lending. What do we rather do? We rather, people in the class, do only the adjustment between us of the gain loss. If you are able to recollect derivative in the convergence chart, below the convergence chart, we all read about the net settlement, settling the gain loss between the parties. Actual principal never gets borrowed, which is why it is called as notional principal, people. Notional principal. Right? So, sir, today the contract is entered between the party. Right? On this day, at the end of third month, we will get to know that in the spot market, what actually turns out to be the rate applicable for those 6 months. Because at 0 point, we didn't know, we had that uncertainty. So we agreed upon the contract for the 6 months. Now for the same 6 months, we will look at the interest rate in the market. Sir, when we go to the market, there are different rates. There is 6-month repo. For example, there may be 6-month LIBOR, 6-month SOFR, 6-month treasury bill rate. So which exact rate you will refer to, which exact rate you will look at is called as reference rate. So in the contract, we also end up writing the reference rate. That for the sake of comparison, which rate will you refer? For example, we have agreed upon 6-month SOFR, 6-month LIBOR. Right, these are the types of interest which prevail in the market similar to repo, SOFR, LIBOR, MIBOR, BPLR, or these kinds of rates. So this is called as RR, this is called as FR. Please remember one thing, whatever is my period of borrowing, for example, my borrowing period in this case is 6 months, then my reference rates time period should also be 6 months, otherwise they are not comparable. Imagine my period of borrowing is 6 months and can I compare it with 3-month LIBOR? No. I have to choose a comparable reference rate for them to be compared first thing. Suppose at this point you got to know the 6-month LIBOR in the market turns out to be 10. Try to feel the gain or loss on this FRA. Let's imagine you are a long. You entered into a contract to borrow at the rate of 8%. Rate for the same period in the spot market is 10. What do you feel? Do you feel a gain of 2% for yourself? Yes, that is what I'm saying. Similarly, I entered into a contract to lend at the rate of 8. Rate of interest in the market is 10. I feel loss. Despite rate being 10, I will have to lend you at 8% because I have agreed upon it is a loss to me of 2%. Similarly, sir, if the rate in the market turns out to be 7, it is a loss of 1% for you because you will have to anyways borrow from me at the rate of 8%. You have a loss of 1 and I have a gain of 1%. Perfect. So two parties, gain loss also you understand. Perfect. Now let me tell you few more things. Sir, at 0 point, when the rates get decided, we could also figure out the gain loss. Whenever you borrow at this point, when should the interest generally be settled? At the end of borrowing period, yes sir. So accordingly, when should the gain loss logically be settled? At this point. Whatever is that 1% or 2%, whatever it is, it should also be settled at the end of 9 months, correct? So sir, logically, how much should be the settlement amount? We will say on a period of 10 lakhs. Suppose you gain 2%, suppose on an amount of 10 lakh, suppose you gain 2%. But do you agree the rates of 10 and 8% were per annum rates, and your period of borrowing is only 6 by 12. So this is the amount of gain should be net settled between the parties at this point. But you know, when is an FRA actually settled? An FRA is actually settled at the start of the period. At the start of the borrowing period, as soon as the rate for the next 6 months is available in the market, you end up settling the contract. But sir, the gain loss which stand at the end of 9th month, if it is settled at the end of 3rd month, should it be done the present value? Yes, which is why whatever is the reference rate in the market, for example, the reference rate turns out to be 10%. For a period of 6 by 12, you discount the net gain loss and bring it to 3rd month end from 9th month end. Yes, which means if you realize a contract is entered here, the contract gets expired or it gets settled here only at the start of the borrowing period. At the end of 3rd month only it gets settled, which is why you are doing the present value of that gain loss, which should ideally be settled at the end of 9th month. Yes, which means understanding gain loss is fine, but calculating gain loss is also needed. That whatever is the notional principal multiplied by difference between the two rates. Don't take it plus minus. I have put the absolute sign, meaning to say whatever is the agreed rate minus whatever become the spot reference rate for the same period multiplied by whatever was the period of borrowing, because these rates are per annum, divided by 1 plus. What is the rate at which you will discount? Is it the reference rate or the forward rate? It is the spot reference rate multiplied by time period for which discounting has to happen. This is calculating the settlement amount or gain loss. Everyone, requesting your responses. Am I able to convey to you how an agreement looks like and how does the calculation work? In the entire interest rate risk management, if we are not able to understand the contract, then forget if we would be able to solve its practical question or understand further concept. Guys, on this particular point, I need a validation of every single student sitting here. Are you all 10 out of 10 set? Come on, tell me. Recorded people, come on, tell me. I'm yet to speak, although I'm yet to speak. Sir, every FRA has a name, meaning to say this is a contract to borrow after 3 months for a period of 6 months, which is the borrowing will continue from 3 to 9. This is called as FRA 3 to 9. Sir, it is after 3 months for a period of 3 months, then it will be called as FRA 3 by 6. That's how this FRA is named as. That's how this FRA is named. Yes. The next people in the class is knowing the position. You who entered into a contract to borrow. So contract to borrow is considered long position. And me who entered into a contract to sell is a contract to lend is considered as short position. Sir, please remember, in case of FRA, the time period, the adjustment related to time period is done considering 360 days. For example, if it is 180 days, then 180 divided by 360, not 365. It is month 3 divided by 12 or 6 divided by 12 is okay. Yes. So in the entire AFM, there are 3 places where the 360 is being used. One is fixed income security, right, which is equity value security valuation chapter, in which we have money market instruments, money market security, in which there is something called as discount yield. That is where it is. Second place is this, and all this has been compiled in the basics. In the basics, if I take you, you will see day counting rules. Let me show it to you once. In the basics of AFM, which is in the Outnotes initial pages, I'll show you the day counting rules. Really easy. I've already taught it to you in derivatives, but see, you might not have seen that derivative video, which is why I'll have to explain it again. Sir, suppose you start an FRA on 15th November and the FRA expires on 15th Jan. What is the time period? Normal rule of day counting is that you don't count the start day. So 15th November has ended. 16th November to 30th November 15 days, then December 31 days, Jan 15 days, total of 61 days. Logical. Similarly, 31st October to 15th Jan, count from 1st November to 15th Jan, it is 76 days. Similarly, from 1st November to 15th Jan is the main thing I wanted to teach, that whenever examiner give you start of the month as as the start date, it is the start of the month. For example, rather than 15th November, 31st October, it is 1st November, 1st December, 1st June. Then you will have to count that start date as well as the end date. Right from 1st November to 30th November will be 30 days. 31 days of December and 15 days of Jan. This is also 76 as similar to the previous one. Could I please explain what is the main point of learning, sir? How do you know this rule? I have observed institutes multiple questions and realized that this is what institute is doing. Except for 1 or 2 questions in the entire curriculum, institute has always followed this particular rule. Correct? Sir, that you do only when the dates are given. When the dates are not given, month is given, life is sorted. Sir, 3 places you take 360. Discount yield, money market, fixed income security, FRA in derivatives, and generic swap in derivatives, as we'll read in this lecture. Perfect. So taking you back to the discussion on FRA. Taking you back to the discussion. Where is my discussion on FRA? Forward rate agreement. Here it is. Cool? Fine. So now I think, sir, we are super set, super sorted with this entire concept of FRA. Perfect. Great. So let's solve a practical question. But before that, you have learned what the contract is. You have learned how do you settle it. But why do you enter into a contract? As I said, only 3 possible reasons one can have that to enter into a derivative. Either speculation or hedging or arbitrage. In FRA, we have hedging and arbitrage both. In all other contracts, we have only hedging to be learned. Speculation is not there at all. Perfect. Arbitrage, we will first learn hedging. Sorry, FRA, we will first learn hedging. The golden rule, do you remember I taught to you in derivatives? The golden rule says, do in derivatives the same thing that you will do in the spot market on a later date if you want to hedge. If you want to hedge, in order to hedge, do the same thing in derivative that you will do in the spot market on a later date. Sir, for example, you are planning to borrow in the spot market after 3 months for a period of 6 months. So in the derivatives today, in the FRA today, if you want to hedge, borrow under FRA, which means enter into a contract to borrow, meaning to enter into a long position. Similarly, if you are planning to lend or invest after 6 months, enter into an FRA, a contract to lend today only, take a short position FRA. That is how the golden rule works. Sir, can you justify if this is correct or not? Let me prove it to you. Imagine that a 6/9 FRA is 8%, which means after 6 months in the spot market for a period of 3 months, I would once want to be borrower and I would once want to be a lender. Correct? Making it the most comprehensive for you. After 6 months for a period of 3 months in the spot market, I am planning to be borrower and lender. Accordingly, as per golden rule, what position should I take in the derivative today? Sir, enter into a contract. As a borrower, enter into a contract to borrow, which means take a long position in FRA. Here you take a short position in FRA. So today I have 2 positions. Sir, after 6 months, for a period of 3 months, after 6 months, for that 3 months, suppose the rate in the market turns out to be 6 and 11. So if the rate is 6 as a borrower in the spot market, please imagine again there are 2 markets. The spot market where the actual borrowing lending with the bank happens. Another is derivative market where this contract is being entered. All these terminology comes from the chapter of derivatives, if you all understand. Correct? In the spot market, when I go to the bank to borrow at the rate of 6%, I'll have to pay him 6. And if the rate is 11, I'll have to pay him 11. Correct? Now I go to the derivative market where I know that I had entered into a contract previously. Right? Please imagine what is happening. Sir, I stand right now at this point where I went to the bank to borrow at 6 or 11%. At 0 point, I remember I had entered into FRA to borrow or lend in this period, to borrow or lend for this period. Correct? So let's do a net settlement. We will say we entered into a contract to borrow at the rate of 8% before 6 months. Now the rate is 6. So please imagine the gain loss. I had entered into a contract to borrow at 8. Rate is 6. Sir, do you feel a loss for yourself? Yes, a loss of 2%. So in the spot market, you paid 6. In the derivative market, you paid 2. Overall, you paid 8%. Sir, if the rate in the market is 11, in the spot you paid 11, life is okay. In the derivative market, you will say what? You will say what? That you have an enter into a contract, you have a contract to borrow at 8, rate in the market is 11. Do you feel a gain of 3% for you? Yes, so you receive 3 in case of net settlement. Meaning to say 11 you paid in the spot, 3 you received in the derivative. Overall, the net or the effective of both the markets is 8% that you paid. So could you understand how it works? Sir, similarly lender, sir, 6% if I lend, I will receive 6 in the market. If the rate is 11, I will receive 11 in the market. Right? In the derivative, what happened? Sir, if the rate turns out to be 6, I had entered into a contract to lend at the rate of 8. Market rate is 6. I feel a gain of 2% for myself, and the total I will receive is 8. 6 I receive from here, 2 from here, total 8 I receive. Sir, if the rate in the market is 11 and I had entered into a contract to lend at 8, it is a 3% loss to me because I had entered into a contract to lend at a lower rate. Right? At a lower rate. It is a 3% loss to me, which means people in the class, sir, 11 I receive from spot market, 3 I pay in the derivatives, net I am 8. Can you please observe? It is the position that you took as per golden rule ultimately created the gain loss in the derivative such that the final outcome, the net outcome, the effective outcome is same as FRA rate. Are you people feeling that you are hedged? Are you feeling that irrespective of uncertainty of the spot market, in the spot market, the rate that will be there after 6 months for a period of 3 months was uncertain? But in the spot market, when there is an uncertainty, you can hedge it by taking a position in the derivative market that you took here through golden rule. And this position has done the gain loss to you such that you overall net of both the market remains hedged, remains fixed at the rate of 8%. Could I please explain it to you? Come on, tell me. So on a lighter note, just want to state the hedging again. In the spot market, you have an uncertainty. Although I've explained all these things in derivative, just repeating it for you. So I would strictly recommend, if you're watching up this video, before this, you should be clear with the concepts of derivatives. If you're not clear at your own, then an amazing video on derivatives is already there. Yes, boss. So what I said, spot market, gain loss may happen. There's an uncertainty. See the uncertainty. So you take a position in the derivative today. The objective is to eliminate those uncertainties. So with the help of gain loss that happens in the derivative, overall you remain hedged. Real me pad. Again, I forgot your name. What is your name? I ask it every day, I know it, but I end up forgetting it. Good morning. Very good morning. Yes, boss. Yes, boss. So, sir, this is how we have justified that, sir, hedging works. So any which ways, let's go to the practical question. 48 is not what we're gonna do in the class. Neither it is 49. It is question number 50 that will do. Come on. Come on. Messrs. Parker is contemplating to borrow rupees 60 crore for a period of 3 months in 6 months time. After 6 months, for a period of 3 months, I'm planning to borrow, which means, can you feel the detail of spot market given to me? Yes. Current rate is 9, but it may go up in 6 months time. Can you feel the uncertainty that happens in the spot market? Yes, fine. The company wants to hedge itself against likely increase in the interest rate. Fine. The company bank quoted FRA of 9.3%. What will be the final settlement amount if the actual rate of interest after 3 months turns out to be 9.6 and 8.8? You agreed into a contract to borrow after 6 months for a period of 3 months, which means till 9 months. After 6 months, the actual rate of interest turns out to be 9.6 and 8.8. My question is, after 6 months, For how many months? So obviously if my contract period is 3 months, then the spot rate has to be for a comparable period, then they are also 3-month rate of interest. I mean they are per annum but applicable for a 3-month blending borrowing. Fine. Your agreed rate of interest was how much? 9.3. Do you remember a particular thing? No one can ever tell you the gain loss unless the position is clear. Sir, we have learnt it in the outnote. Same situation, long position if is a gain, short position will be a loss. Or if short is a gain, long will be a loss. That common sense you should be clear with. So first of all, you should be clear with the position you are taking in FRA. Then only you will be able to tell him the final settlement amount. Can you all please apply the golden rule and tell me what will be the position you should take as a borrower? As a borrower, I should also be I should borrow in the derivatives also as per golden rule. And borrower, so just a reminder, those who have not watched the derivative video, golden rule is not something that institute has given to us. It is something we have created for our own in the class, which applies to IRRM, which applies to derivative, which applies to forex. Whenever in the entire AFM there is hedging, there is golden rule, which makes your decision to take position for hedging really easy. Otherwise, a student generally end up getting confused. They have a longer way to think, a more complicated way to think. For us, it's a golden rule, simplest ever way to figure out hedging. Right? So, Ujjwal, very good morning. Yes, great. Sir, come on. Sir, I need to figure out my position. Can you all try to figure out what should the position be? Sir, since I'm a borrower in the spot, then I will have to enter into a contract to borrow at the rate of 9.3 after 6 months for a period of 3 months. The FRA rate is 9.3, right? Sir, rate in the market turns out to be 9.6. Do you feel a gain? Yes, sir, of 0.3%. So 60 crore into 0.3% for a period of 3 months. 60 crores into 0.3% into 3 divided by 12 is 0.045 crore, but we need to discount it, right? So put it to M plus. So discounting rate should be the reference rate. So 0.096 into 3 divided by 12 plus 1, divide equal to into memory recollect into 1 crore is 4394.53 as the answer to this particular thing, which is my gain. Yes. Which means remember that in our class we don't do a mug up of the formula whether it is reference rate minus a spot rate or whether it is a spot rate minus reference rate. The simple logic is, in case of lender the formula will be different, in case of borrower the formula will be different. So rather than mugging up the formula, do you understand the gain loss at your own? Do you understand this table really well, which we have learned here, this particular table? So automatically create a formula. That when it is gain, you get a positive answer. When it is loss, you get a negative answer. Life gets sorted. For example, here it is a gain to me that you felt. So gain will happen only when you deduct 9.6 from 9.3 to get a positive answer. 9.6 minus 9.3 will be positive. So formula will automatically, reference rate will be for minus forward rate. Logic? Question 50 first part gets done, 8.8 part you will have to do at your own. To be able to solve next question, I'll have to teach you the next concept, which is people in the class, pricing on FRA. Again everyone, this particular concept relates to fixed income security, where we learn to calculate forward rates using spot rate. Just give me a minute, I'll try to teach you. Give me a minute. Yes. Sir, what the concept is, let me explain. At 0 point, I have the spot rate that prevails in the market. Fine. I also have the forward rate that prevails in the market, but that is actually actual forward rate. What should be the forward rate, or that intrinsic or implied forward rate? Can we calculate that today this is the market forward rate, but what should be the forward rate? Is it fair? Like what should be the fair forward rate is what we want to calculate. Logic is really simple. If I have a 6-month spot rate and a 12-month spot rate, then I can calculate 6 by 12 forward rate. Sir, how would you calculate? Really easy. Let's assume 6-month LIBOR is 5%. Let's assume 12-month LIBOR is 6%. What is this rate? Simple. Let's assume the 6-month forward rate to be fair forward rate 6 by 12. Let's assume this is the name. If I have 1 rupee here to invest and if I want to invest it for a period of 12 months, then do you agree there are two ways to invest? One, this path, path A, another is path B, which means this 1 rupee if I want to invest, I can invest as one shot at the rate of 12% at the rate of, one shot for a period of 12 months at the rate of 6%. My amount of 1 rupee will be after a year become 1.06. Common sense. Similarly, I have another option. Option 2 is first invested for a period of 6 months at the rate of 5%, which means this 1 rupee after 6 months it will become 1.025. Then for a further period of 6 months, you can invest it, sir, using whatever is the forward rate. So suppose 1 plus X is the forward rate per annum for a further period of 6 by 12. Right? 1 plus whatever is the forward rate, calling it to be X, that per annum rate multiplied by 6 by 12 is I have further invested this redeemed amount of 1.025. And do you agree? Since the period of investment in both the cases is for 12 months, I should be able to have redeemed the same amount. The future value of this 1 rupee under both the cases, under both the paths should be same. If you understand the logic, you end up creating an equation. So it is like 1 plus 5% for 6 by 12 into 1 plus fair forward rate of 6 by 12 for 6 divided by 12 period is equal to 1.06 12 by 12. This entire equation where we are matching future value 1 with future value 2 has only one variable missing, which is fair forward rate. You solve it on the calculator, so it's like 1.06 divided by 1.025 minus 1 into 12 divided by 6. When you solve it, it is 6.83% fair forward rate of 6 by 12. So this is pricing in FRA, that today when we enter into a contract, what should be the rate at which what is the rate that at which the contract should be entered? Do you remember cost of carry model, pricing a future contract or pricing a forward contract, which was what was the rate at which gold should be bought today? Sorry, what is the price at which a contract should be entered today to buy the gold on a future date? Similarly, what is the rate at which a contract should be entered today to borrow or lend on a future date? That is fair, should be the rate. Actual rate prevails in the market. Sir, when the actual is different from fair, then there is mispricing. Now I'm trying to teach to you the concept of arbitrage. Although we have discussed them in the derivative one, but quickly in 2 minutes, please understand. When something has a different price than how much it should be, then we call it as mispricing. And whenever there is mispricing, we try to gain advantage of this mispricing by buying something, selling something, borrowing something, lending something. That process of buying and selling, borrowing and lending is called as arbitrage. Due to mispricing, you take in the position of derivative of buying, selling, borrowing, lending. The intention is to make a profit out of that mispricing. It is called as arbitrage. People, how do you do arbitrage? Look at this. Sir, with this equation, we got a fair rate. Suppose the actual rate in the market is fine. The actual forward rate given by the bank is 5%. Please comment on 5 because that is actually, you always comment on the actual. The rate of 6 by 12 should be 6.83 but it is 5. What will you do? When the market rate of interest is lower than how much it should be, I would want to borrow at that rate, correct? If the conclusion in your brain is clear that you would want to borrow, then please understand how the arbitrage will happen. You will say on this path, entire path you will borrow. So let's say 1000 rupee you borrow on path A. Then you find out the amount of repayment here. Step 2 is you invest the same 1000 rupee here. So you redeem the amount of redemption here. From the redeemed amount, if you repay the borrowed amount, you will automatically get a gain, which is your arbitrage gain. That simple is the process of arbitrage. Are you understanding? Similarly, if the rate in the market is 7, You will have to comment always on the actual rate. We will say 7 is more than how much it should be, which is 6.83. So when something is overvalued, what something is more than how much it should be, what would you want to do, invest or borrow? You would want to invest at that rate, means entire path A you will invest, which means which path you will borrow? You will borrow at this path. So let's say you borrow rupee 1000 on this path, and with this rate you know how much to repay after 12 months. Step 2, you invest that borrowed amount here under path A. Find out that with these two interest rate, how much will you redeem? So from the amount that you redeem, if you deduct the amount that you need to repay, automatically whatever is left is your gain. That simple is the arbitrage process. Sir, that is what has been written here, for which we're gonna do the practical question right now in the class. Are you all please superset? Come on. Are you all please superset? Sir, let's proceed to solve that particular question. Question number 51 from the study material. Come on. Yes. The following market data is available. What is the data available? Sir, spot USD JPY 116. Okay, you may ignore it. Deposit rates. For a 3 month, if you want to deposit in USD, it is 4.5% per annum. If you want to deposit is in yen, it is 0.25% per annum. For 6 months, if you want to deposit in USD, it is 5%. In yen, it is 0.25%. Question 1. What is the forward rate agreement for yen? What is the forward rate agreement for yen? The answer actually is what they try to ask. 3-month rate is this, 6-month rate is this. What is 3 to 6 rate? That's their ideal question. So they feel this is 0.25, this is 0.25, so this one will be 0. That is what they are trying to answer, which is absolutely incorrect. Correct? When you solve it, it won't be 0. Sir, since they have answered that forward rate agreement of yen is nil, you will have to continue to answer as this is an ambiguity in the first part, which is theoretical. The rest all question is clear and logical. So first part, kindly accept the ambiguity. The forward rate agreement of yen is nil. We accept it. Okay. Sir, what should be? 3-month FRA at 3-month forward. Now which currency? Obviously USD, because yen has been over. 3-month FRA at 3-month forward, meaning to say 3-month FRA means the period of borrowing. At 3-month forward means after 3 months. So after 3 months, for a period of 3 months, what will be the rate? Sir, 3-month rate is 4.5, 6-month rate is 5%. Then what will be this rate? Common sense. Once you create this equation, then you create this equation and equate the future values, you will get the answer. Sir, 1.05 for a period of 6/12 one shot, right? This is 6 month, this is 3 month. Plus 1.045 into 3/12, 1 plus fair forward rate for the next period of 3/12 is the equation. When you solve this equation, you have only one number missing of fair forward rate. When you solve it, you get 5.44% as the fair forward rate. Could I please, people in the class, teach you how do you calculate the fair forward rate? Next, C part. If 6-month and 12-month LIBOR are 5 and 6.5%, bank is quoting 6/12 USD FRA. What they want to say, 6/12 USD FRA means borrow for 6 after a period of 6 months as 6.5 and 6.75. Sir, what is this? Sir, 6-month, 12-month LIBOR given. Using 6-month, 12-month spot rate, we can find out 6/12 forward rate. Fair. 6/12 actual forward rate is also given. Sir, why are 2 rates given? When we lend to the bank, when we enter into an agreement to lend to bank, it will be 6.5. When we enter into an agreement to borrow from bank, it will be 6.75. Is there any arbitrage? So again, we calculate a fair forward rate. I'm just not calculating it again because we have just done it taking the number directly of 7.8. According to our logic, 7.8 should be the forward rate. The rate in the market is this. Can you feel? Comment on the actual. Can you feel the rates are undervalued? Sir, which rate to take? Take any. Both of them will be either this side or that side. Right now, both the rates are undervalued. What do we say? What do we say? Since they are undervalued, we will borrow under path 1. Look at the chart. For 6 months, 5% is the rate. for the next 6 months, for the 12 months, 6.5 is the rate, then according to us 7 point it should be. If the actual is this particular rate, then what we say? We say that borrow under this path and invest under this path. Apply common sense when you borrow $1,000 here. Sir, why dollars? Because USD FRA applicable to USD currency. Sir, when you borrow $1,000 here, it become 1.025 here. So 1000 into 1 plus 0.05 into 6 by 12 plus 1 plus. Sir, what is the rate at which we will be able to actually borrow under FRA? Is it the fair rate? No. Fair is only in our notebook. The actual borrowing rate in the market is 6.75%. So 1 plus 6.75% into 6 by 12. So 0.0675 into 6 divided by 12 plus 1 m plus 0.05 into 6 divided by 12 plus 1 into memory recollect multiplied by 1000 give me 1059.59 the amount to be repaid. This is our understanding. If you're able to imagine this timeline, then no question of arbitrage will ever be difficult to you. This is not for examiner, it is only for you and me to understand. Yes, sir, borrow $1,000, 5% 6 months, buy 6 by 12 FRA, outflow at the end of 12 months. This. Similarly, which means for the sake of arbitrage, we don't have to do any net settlement of FRA. We have to just assume an actual borrowing or lending at the agreed forward rate of 6.75%. Yes. Now you say invest this 1000 rupee for 6.5. So after a year it become 1065. From the redeemed amount, repay this amount. The difference is your arbitrage gain, 5.41. It will always be your arbitrage gain, never arbitrage loss, provided you have chosen your step correctly. If you by mistake end up investing here and borrowing here, then it's a loss. Otherwise, it is never. Perfect. The question 51 along with the concept of arbitrage gets done. I will now take you to the next concept, which is the concept of interest rate options, cap and floor. I need a validation. Boss, all the live people sitting in the class here, can we all proceed to learn the next concept and solve one question of each type? Come on. Come on. So, do you remember in the subject of derivatives, then there was something call and put. Similar to that, we have cap and floor. Sir, how does that work? Let me explain. Suppose there is this piece of paper. This piece of paper is called as a contract, a derivative contract. This piece of paper, when I sell to you, you buy it. Your position become long, my position become short. When you buy something, what do you have? A long position. When I sell something, what do I have? A short position. But what have you bought? What does that piece of paper, what does that contract has? Sir, what does that contract have? If it is a cap option, that piece of paper, that contract has an option to borrow. What is this piece of paper giving? An option to borrow. Since you bought it, you got an option to borrow. So since I sold it, it is like I have given to you that you can borrow at a particular rate. This contract is an option to borrow at a particular rate that gets decided today only. Similarly, again imagine this is a piece of paper, a contract. I have sold this piece of paper to you, which means you have a long position, I have a short position. But you have a long position or you have bought something, but what is that something? Sir, this time this paper which you have bought is a option to lend. This piece of paper is an option to lend, which means you have bought an option to lend, which means if you want, if you find it okay, if you find it beneficial, you will lend to me at a particular rate. Sir, what is my position? I have given an option to you that if you want, you can lend to me at a particular rate. My position is short. Two things really important. What the contract is. Cap is an option to borrow. Floor is an option to lend. When you have a long position, you have these options. If I have short position, I have given these options to you. Simple, basic. So first is understanding what kind of contract it is. Second, the realizing the fact that we have multiple borrowing periods covered in a single contract. For example, at 0 point we enter into a contract. You take long, I take short. Let's say it is cap. So it is a contract to borrow. A particular amount of 10 lakh rupees, again it is only notional. The actual lending borrowing will never happen, it will only be the net settlement. Sir, suppose after the expiry is 9 months, which means the contract that created here will get expired at the end of 9 months, where exercise rate is 8%. Meaning to say, there is an option to borrow at the rate of 8%. Meaning to say, there is an option to borrow at the rate of 8%. You have the option because your position is long. And the reference rate is 3-month LIBOR. Meaning to say, as we learnt in FRA, for the purpose of calculating gain loss, we need a rate which can be compared with the given rate of 8%. What is that rate for the sake of comparison? Which rate will be referred to for calculating gain loss? It is 3-month LIBOR. Do you know 3-month LIBOR, what does it imply? 3-month LIBOR implies that at 0 point the rate applicable for the next 3 months gets decided, which gets settled at the end of 3rd month. Again, for the further next 3 months, the rate applicable gets decided, which gets settled at the end of 6th month, and for the next 3 months further gets rate decided, which gets settled at the end of 9th month. Could you understand that in an overall period of 9 months, because of reference rate being 3 months, I will have a quarterly settlement, and total 3, 1, 2 and 3 settlement will happen in a period of 9 months. Meaning to say, in a single period, a single interest rate or guarantee contract, interest rate option or guarantee contract, we can have multiple settlement periods depending upon the reference rate, depending upon the frequency of settlement. Right. Sir, how does it work? Let me explain. At 0 point rate for the next 3 months gets decided at 10%. You have an option to borrow. Think of yourself, you have an option to borrow. At the rate of 8%, you can borrow. Rate in the market is 10. Will you borrow? Yes. Will you exercise the option to borrow at 8? Yes, you will exercise. If you exercise, what will be the gain loss? We will discuss it later. But you can feel the common sense. You can feel the common sense. Sir, here, the rate you get to know because this was the reset date. It was applicable for 0 month to 3 month. It was my reset period. The settlement of interest generally happens at the end of the period, right? And even in case of options or cap floor, the settlement happens here only, unlike FRA where the discounting was being done. If this is the period of borrowing, then settlement happens at the end of borrowing period, unlike FRA where it was the start of the borrowing period. Sir, how much will be the amount of gain loss being settled? Common sense. On an amount of 10 lakh. You feel that you have gained 2, but only for a period of 3 by 12 months, because the rates were per annum and your borrowing period is just 3 months. So whatever you have gained is for 3 months, right? That's how people in the class, the settlement of amount happens at the end of 3rd month, which means again for the next 3 months, if the rate is 7, you have a contract to borrow at 8. Will you exercise the contract? No, contract will get lapsed. And here also, if the rate is 8, you will get 0 rupee as your payoff. The contract gets lapsed, which means if the rate in the market is more than the exercise rate, or the exercise rate is less than the spot rate, then we can say that the contract gets exercised. Similarly, suppose this time let's talk about floor. You have a contract, you have a choice, you have a decision to option to lend to me at the rate of 8%. Rate in the market is 10. Will you lend to me at 8? Lapse. Rate in the market is 7. Will you lend to me at the rate of 8%? The answer is yes. You will exercise the contract. The rate in the market turns out to be 8, contract will get lapsed. So here when you exercise the contract, although the rate you got to know here, but the settlement will happen at the end of 6 months. You got to know the rate at the end of 3rd month, which means the start of 4th month itself, applicable for the next 3 months. But the settlement happens at the end of 6 months. Sir, what is the settlement amount? Settlement amount is really simple. You have a contract to borrow, option to borrow at 8. Rate in the market is 7. What do you feel? Gain of 1%. Don't remember the formula of what minus what. Do anything. If it is a gain, which you will exercise only when it is a gain. So do exercise rate minus reference rate here. Exercise rate minus reference rate automatically give you the gain feeling, sir. So 1% is the amount of gain for a period of 3 by 12 month on a notional principal of 10 lakh will automatically give you the settlement amount of 6 month end. Simple. This is the contract that we have talked about. Now the point is similar to call put. You took a long position, you got an option. So whenever it is a gain to you, you are exercising. Whenever it is a loss to you or gain to me, you are not exercising. So why do I give this contract, this option to you? Because at 0 point you pay me a premium. A single premium for all settlement period is paid at 0 point by you to me, which means long who has the option. If it is cap option to borrow, if it is floor option to lend. Short, someone who has given the option to the other party, same to borrow or lend. Sir, this is how the settlement in cash happens. Sir, you as a long has a choice to exercise. If you exercise, you receive the payoff. If it is lost to you, you never exercise. But for that, you have to pay a premium. As a short, I will have to pay you payoff. That is agreed, because when you receive, I will pay you the payoff, but I will receive the premium for that at 0 point. Sir, this is the understanding of cash flow. How the practical question would look like when we go to the practical question, we will learn. Let's understand about the hedging ones. Do in derivatives today what you will do in the spot market on a later date. Today you do the same thing. Sir, in the spot market, imagine that you are a borrower. You are planning to borrow over a period of 9 months, right? Sir, if you want to hedge, borrow it today only. Please remember, you always have to take a long position, right? The decision, you always have to take a long position. This is what I had told you even in the Forex. Currency options and futures, I told you in the call put, the decision is not long short, it is always long. The decision is cap floor. Either you want to buy an option to borrow or you want to buy an option to lend is the decision. Golden rule will solve your problem. As a borrower, you know you will borrow in the spot market and do in derivative the same thing today. So buy a cap, it will give an option to borrow. You want to lend in the spot market on a future date, so on a later date. So today you lend. How would you lend? If you buy a floor, you will be able to lend. That is how the hedging position gets decided. Yes, don't think the complicated way that how I will gain, I should take that position. No. Don't think of the gain loss. This golden rule solves your problems in the entire AFM multiple chapters, right? Sir, something related, something which is an extension of hedging, which is collar strategy. As a borrower, you will long cap, but do you agree? Buying a long option ultimately make you pay the premium. Ultimately, you have to make the payment of the premium for the long, which will increase your cost. So simultaneously, you also take a short position in the floor. You not only buy cap, which means have the option to borrow. You also sell floor. You give the other party an option that he can, what is the option? Floor option. He can lend it to me is the option given to him. When he lend it to me, I will automatically ultimately end up borrowing, which is why long cap plus short floor will save my premium. When you long cap, you pay premium. When you short floor, you receive premium, and that's how everyone, this strategy is called as collar strategy. Yes. So this is what it is, for which I'll take you to a practical question. 52nd. The practical question we don't need to do because it's all easy. Only the ambiguity I want to tell you in this question. I have taught to you one thing which is logical, that for example 1st April 12 to March 13, April 12 to March 13 is this year. For this first year, the rate of interest that will prevail in the spot market gets decided in the start of the period, right? Similarly, rate for next period gets decided in this at this point, the start of that period and so on. Unfortunately, in this question, Institute assumed the reset date not to be the start period but the end period. That for the period of March 13, right? For this 1 year, the rate get decided on 31st March 13 as 10.2. So don't think logical that the rate which gets decided on 31st March 13 is the rate applicable for the coming 1 year. If you apply logic, you will fail. This is the unfortunate ambiguity that we will face, but the way to remember is really easy. You have 1 year, 2 year, 3 year, and 4 year. And you have been given the rates, the spot reference rate of respective year end. So you anyways don't have a choice to assume it for the next year, because otherwise the last rate will be for which period? The period is not there in the question only. Are you understanding? And also the first period will be without any rate. As per your assumption, as per logical assumption, there is no rate given for the first period then. So this was the ambiguity I wanted to explain that you need to follow. Otherwise the question is really easy. Question 53 that we're going to do entirely in the class. A scam that happened in the attempt of May 22. The same ambiguity that I explained in the previous question used to be there in this question when it was there in the study material. In the attempt of May 22, Institute randomly rectified the solution of this question in the suggested answer. Although Institute did not pre-inform, but the rectification it has done is also not 100% logical. So what happens in this question? They say, let me explain, then I'll explain the ambiguity, then we'll do the solution. Cool? I want 100% attention of every single student. Come on. MPD Limited issues a ₹50 floating rate loan. When you issue a loan, please don't consider yourself to be the bank issuing the loan. They are like floating rate loan is a type of instrument security debenture, also called as floating rate note. When you issue a debenture, you are actually borrowing. So think from borrowing perspective. Think from borrowing perspective that you are issuing a 50 million. You are borrowing 50 million rupee. On 1st July 18, you are borrowing with resetting of coupon every 6 months, which means what are you borrowing at the rate of 6-month LIBOR plus 50 basis point is 5.5% for every 6 months from 1st July 18 for every 6 months. Whatever is the amount LIBOR in the market plus 0.5 is the rate of interest I will have to pay in my spot market on my borrowing. Clear? Next. This is interested in interest rate collar strategy. Now it comes to hedging. Please feel the flow of the question. The hedging question always look like something is given about the spot market, which has uncertainty. Now to hedge that uncertainty, we do this in the derivative market. Yes, MPT is interested in interest rate collar strategy of selling floor buying a cap. This is a reconfirmation that we are a borrower, because if you buy a cap, it is only possible when you are a borrower, otherwise you will never. Sir, MPT buys a 3-year cap and sell 3-year floor with the following details. On 1st July, you 3-year cap and 3-year floor, you do the transaction. Principal amount 50 million, same as a spot market. Strike rate, the exercise rate. Option to borrow I have at the rate of 8%. Option to borrow I have because the position is long at the rate of 8%. Floor is option to lend, but I have given because the position is short. I have given an option to lend to me at the rate of 5%. Fine. Reference rate 6-month LIBOR, premium gets cancelled, received gets cancelled with the paid. Reset dates are 31st December 18. The first reset date is this. Rather than rectifying the solution, institute could have rectified the question. The first reset date they could have given of this point, so that my first period of borrowing in the spot market and my first period of derivative market can match. Now what they have done, unfortunately, they say 1st December 18 is my first period, first reset date. And logic, as per logic, the 7% of rate is applicable for the next 6 months, because the reset date is the start of the period date. So when something gets decided on 31st December 18, it gets applicable till 30th June 19. This is the scam they have done, which means for the first period there is no information. Are you understanding? So they tried to rectify the solution without applying their brain. Please think logically. If this is for a period of 3 years, my 3 year will get over here, right? When would my 3 year get over? From 1/7/18 to 30th June 21, my 3 period will get over. But the last period, the reset date if is 30th June, it will be applicable for further 6 months. How would how would I do this? How do I do the net settlement after the contract getting expired? Are you understanding? Which is why they tried to rectify without applying their brain. But unfortunately, we will have to continue to do now the rectified solution. Sir, at the end of every 6 months, what are the rates in the LIBOR they have given to me? What I have to do? Sir, calculate effective interest paid out at each reset date. No, each settlement date should be the word logically. They rectified but could not completely rectify. Sir, interest effective means in the spot market you pay LIBOR plus 0.5. In the derivative market you have long cap, there will be some payoff. There is a short floor, some payoff. So net of all three position, what is the net or the effective of every period, that we need to find out. Could I simplify the question for you? Everyone in the class, you know what is the main point of learning? The main point of learning, people in the class, here is something else only. The main point of learning is knowing the detailings first. My first period is to be now considered this. From 1/1/19 to 30th of June of 19 is my first period now, because the reset date is 31 December 18. Second point of learning, since dates have been given, I will have to do day-wise calculation, not month-wise calculation, something you will have to remember. So from 1st Jan 19, 31 days of Jan, 30 day of Feb, 31 days of Jan, 28 days of Feb, 31 days of March, 30 of April, 31 of May, 30 of June, give me 181 days. For this period, rate in the market is 7, so I will have to pay the interest at the rate of 7.5 in the spot market. So on 50 million at the rate of 7.5, 50 million into 7.5% for a period of 181 divided by 365 is 1859589. 1859589 is the amount of interest you will have to pay in the spot market. Sir, now think about cap floor, think about position. Let's make the concept clear. I have the cap, I have the option, I will receive the payoff if I exercise. Floor, I have sold, given the option to the other party. If the other party exercises, he will receive the payoff, means I will have to pay the payoff. Here, in case of cap, if it is there, payoff will be inflow. In case of floor, if it is there, payoff will be outflow. Yes, fine, sir. Sir, rate in the market is 7. For the purpose of comparison, I will compare the exercise rates with what? With LIBOR or LIBOR plus 0.5. As I said, it is the reference rate that you always look at, not the rate at which you have borrowed in the spot market. Spot market is a different story, derivative is a different contract. So 8 and 5 will be compared with this rate. I have an option to borrow at 8. The rate in the market is 7. Will you borrow? No lapse. The rate in the market is 7. I have given an option to the other party to lend to me at 5. Will he lend to me at 5 if the rate is 7? No. So effective overall is this. Similarly, you do it for next period, next period, next period, next period, next period. I will now tell you some detailings. Sir, when the time period is 30th June 19, right? On the next day, when the 30th June 19. So my borrowing period is 1st July 19 to 31st December 19, giving you 84 days, 184 days. At the rate of 8%, you do the calculation, that is also fine. Next thing, when the date is 31st December 19, next 6 month is 1st January 20 to 30th June 20. Sir, this is a leap year. Something you will have to unfortunately remember. Sir, this question is logical, but is somewhere typical because has a small things to remember. Sir, it is a leap year. So total it will be 182 divided by 366 days. The calculation will be based on 182 divided by 366. So 8.5 is the rate. In the spot market, it will become 9. So on 650 million at the rate of 9% for 182 divided by 366 will be this amount of interest you pay in the spot. Now think about derivative. Sir, 8.5 is the rate. I have an option to borrow at 8. Will I exercise? Yeah. How much is my gain? 0.5%. So 50 million into 0.5% into 182 divided by 366 is 124,317 on a rounded off basis is the amount of payoff I receive. So if my outflows I am showing positive, then inflow I will have to show negative. I mean I have to do a net of inflow outflow. Sir, this I receive, floor doesn't get exercised, net is the net of this two. Similarly, here you will also exercise floor here, right? How is the floor exercised? You will be able to think it at your own, and this particular thing gets done. Let me once tell you how does the floor gets exercised. People in the class super fast. Rate in the market is 4.75. You pay 4.75 plus 0.5 in the spot market, fine. Cap doesn't get exercised, floor, which means you have given an option to the other party. If other party wants, they can lend you at 5. If the rate is 4.75, will it lend? Yes. How much is his gain? 0.25. Which means he will receive 0.25%, means I'll have to pay him 0.25, right, of 50 million for a period of whatever number of days. Now please understand one more thing. In the next slot, the numerator is 184 days, but the denominator will continue to remain 366 because in that year, the total number of days were 366. This particular time period is from 1st July to 31st December, which is 184 only, but the denominator is 366. That's how the calculation will happen. Except for that, this question, the first part has nothing else beyond it. Meaning to say, people in the class, at the end of every 6 months, we will calculate the effective interest rate, which is the net of all the markets. That is what institute has asked. Next, everyone, is average overall effective rate of interest per annum. Average overall effective rate of interest per annum. Average effective rate of interest per annum. What do they mean to say? Average overall means over a period of 3 months. On an average basis, over a period of 3 months, on an average basis, in percentage terms, rate is in percentage terms, on a per annum basis, how much is the effective or net rate of all three market? Common sense. Total 101391, this is the interest paid. Over what time period? 3 years. Means 1096 days. Total the days, because in one of the year there were 366 days, which is why. Total in a period of 1096 days, I paid this interest. So for a year which is 365 day, how much is the interest? So 103,10971 divided by 1096 multiplied by 365 give me some interest amount. That is the average overall interest amount effective, but I need rate. So let's convert the interest amount into percentage by dividing the principal being borrowed divided by 50 million, give me 6.867, which is 6.87% as the rate of interest per annum I paid. Question 53 people in the class gets done, where you have learned cap, floor, spot market, net of all three markets, everything, boss. I hope I'm able to convey this question 53. The next question that we're gonna do, everyone in the class, is 56, for which you will have to learn the next concept, which is interest rate futures. Yes, and I want, if you all can take, cool, interest rate futures, let us learn. I have a plan now. Sir, on interest rate futures, if you observe, FRA has only one type of contract, contract to borrow or lend. Similarly, cap floor is only one type of contract, contract to borrow or contract to lend. In interest rate futures, boss, we have two types of contracts actually. One type of contract is contract to borrow lend, and there is another kind of contract which is contract to buy sell. Sir, how can interest rate has buying selling contract? It has a buying or selling of the bond. This is the entire story. If you understand, I will explain, or in fact let me explain, right? But not with great details, because institute has never asked a practical question on this in the exam. Similarly, even if I tell you the entire story here, after that entire story, ultimately there is a conclusion of that story which is to be used in a practical question, which is extremely easy. So let's make the approach for this particular contract, a bit more exam oriented, and let me directly tell you the things which will be of use in the practical question rather than explaining the contract itself in detail. The only contract where we will follow this approach, right? Listen to me. The first category, where the contract is to borrow and lend, the thought process is similar to an FRA. The thought process is similar to FRA. For example, where examiners say 3-month future of 1 lakh rupees expiring in 6 months is trading at 96. What does it mean? First, try to understand the language of the question. Sir, 3-month future means the period of borrowing will be 3 months. Sir, futures are standardized, as you know, in derivatives. Futures are standardized. You can enter into a contract to borrow or lend, not any random amount, but a fixed size of 1 lakh. So you can either make it 1 lakh or 2 lakh or 3 lakh and so on. Right? So 3-month future, which means a contract to borrow or lend. One second. Sorry. A contract to borrow or lend for a period of 3 months, an amount of 1 lakh rupee after a period of 6 months. Expiring is 6 months, is after a period of 6 months, is trading at 96, meaning to say, sir, how can someone borrow at 96? Is it 96% or 96 rupee? It is neither percent not rupee. It is a way to mention the rate. So basically 100 minus 96 give you the contract can be entered at the rate of 4%. This is how the rate is mentioned. So 6 months is the period of contract after which the 3-month borrowing will happen at an amount of 1 lakh rupee at an agreed rate of 4%. This is how you interpret. The thought process is similar to FRA. Now the difference. Difference is, suppose someone wants to borrow 1,50,000. Do you agree he cannot enter into a contract for 150? He will have to either enter one contract or two contracts. So when it comes to the settlement, you will have to find out the difference. Find out the net settlement, which is fine, that on the notional principle of every contract. On the notional principle of every contract, what is the difference gain loss you have? And what is the period of borrowing, right? And that is the gain loss you multiply with whatever number of contracts you have taken. Logical? Rather than multiplying with the overall notional principal, you multiply with the notional principal per contract and then multiply it with the number of contract. Now I will have to teach you how do you figure out the number of contracts taken. One easy example was, sir, if I have to borrow 10 lakh rupees. 10 lakh rupee I have to overall borrow. One contract has 1 lakh. So you borrow 10 contracts. But there is a further level of advancement in this that we're gonna do in the practical question. So let's go to that practical question. Sir, did you realize one thing? In case of futures, we will not do the present value. Sir, why we will not do? Because in that particular question, it is not needed. Let me explain to you what that question is and automatically you will understand. So you have to understand that we are doing this topic only from this question point of view, question number 56. Listen to me very carefully. Electra Space is a consumer firm, business highly seasonal. Sir, coming to the main line. The company is planning to borrow sum of euro 50 million for an entire period of 6 months. Slack season is for a 6-month period that you will know in the first paragraph. So for an entire period of 6 months, in about 3 months, it is planning to borrow. So after 3 months, for a period of 6 months, it is planning to borrow. So on the timeline, let me check if I have drawn it on the timeline or not. Question 56 of derivative and IRRM chapter. $55. 56 does not have timeline in the handmade notes, but I'll explain to you on the timeline. Just give me a second. After 3 months, for a period of 6 months, I want to borrow. Right? Fine. When I went to the market, the bank said the spot rate. Today, when I went to the market, sir, where do I stand? I stand here. Today, when I went to the market, bank said the spot rate is this. 3 by 6 FRA is this and 3 by 9 FRA is this. In order to hedge, in your understanding, which FRA do you think I will need? 3 by 6 or 3 by 9? After 3 months, for a period of 6 months, is actually people in the class. After 3 months, for a period of 6 months, people is actually 3 by 9 FRA if you realize. Which FRA do I need? 3 by 9. So relevant FRA is this. And in that, what position will you take? Sir, since I am a borrower in the spot market, then in the derivative market, I will enter into a contract to borrow and the relevant rate will be 5.94 because I borrow at a higher rate, I lend at a lower rate because the bank is there to earn money. So I will enter into a forward contract here for this particular time period at the rate of 5.94%. Done. Ignore the futures. Ignore the futures. How an FRA shall be useful if the actual rate of interest after 3 months? Sir, after 3 months, let's say the actual rate of interest in the market turns out to be 4.5%. Sir, for what period? Obviously for a period of next 6 months, then otherwise how will the two rates will be compared? How will the forward rate which is agreed upon and the reference rate which it turned out to be, how will the two be comparable? So it is obviously for a period of next 6 months. So agreed forward rate, people, is 5.94%. Rate in the market turns out to be 4.5. What do you have to tell them? Is it the gain loss they are asking? No. They are asking the use of FRA. They are asking the justification for hedging. So we will say, let's justify. Let's say how much in the spot market we paid. How much is the adjustment is derivative market, gain loss adjustment, and how much is overall net. Sir, in the spot market, after 3 months, when we borrow at the rate of 4.5, how much we end up paying? The amount of interest here. Let's say, sir, 50 million euro. 50 into 4.5% into 6 divided by 12. Give me 11,25,000 I paid in the spot market. Fine. Sir, how much is the settlement of FRA? Ideally, the FRA settlement happens here as a present value. But do you agree the interest in the spot market I am paying here at the end of 9 months? When you borrow in the spot market, when do you pay? At the end of the period. Similarly, for FRA, we will not do the present value. We will keep the amount of gain loss at the end of 9 months only, so that we are able to find out the net amount. We can adjust one amount from the another. So this is what I have specified in the note here. If you observe, sir, FRA we are back to, we are saying for hedging questions, present value of gain loss will not be calculated. What is the reason? The reason is really simple. The reason is really simple, that the spot market interest payment is end of the borrowing period. This is my borrowing period from 3 to 9. If the spot market interest is here, let's keep the derivative market here only, so that the effective or net of both the market can happen easily. Sir, which is why if I have agreed to borrow at 5.94, rate in the market is 4.5, do you feel for a loss for yourself as a long position? Yes, sir. Difference is the loss. So 50 million, how much is difference? 4.5 minus 5.94. Sir, 1.4 is the difference. So 50 million into 1.4% into 6 divided by 12 give me 3,60,000 of loss. 1.44%, sorry. 3,60,000 of loss. So 1125 I paid in the spot market as a borrower, 360 I paid in the derivative market for my long position in FRA. Overall I paid 1485. Even if the rate in the market turns out to be 6.5, you paid in the spot 6.5, but you have a gain in the derivative, net you pay 1485. Irrespective of rate in the market, irrespective of uncertainty in the spot market, with the spot plus derivative. Sir, this is a spot, this is derivative. With this spot and derivative market, you remain hedged. Overall, you pay 1485. Sir, can we convert this amount of interest paid net in percentage terms? Yes, 1485 you paid over a period of 6 months. So annualized becomes this. On a principal amount of 15 million, it becomes 5.94%. Effectively, you are ending up to pay the rate equal to FRA rate only, nothing beyond it, more than that. That I've explained the first part. Sir, second part, how 3-month future shall be useful if company interest rate turns out to be same. This time make use of futures. Sir, can I enter into a contract to borrow 50 million in futures? No. Why? Because in futures there is a contract size of 50,000. So sir, when you divide 50 million with 50,000, how many contracts you have to take? 50 million divided by 50,000 give me 1,000 contracts I should take. But there is one more thing that you need to learn in this question. Please pay attention. Sir, what is that thing you have to learn? Please pay attention. Sir, you want to borrow for a period of 6 months. The contract is only for a period of 3 months. Look at this. Look at the line for future. 3 months, 50,000 euro future maturing in 3 months. So there is a contract that will expire after 3 months. But what is the period of borrowing in that contract? Sir, 3 months. Of contract size 50,000, right, is quoted at 94.15, meaning to say the rate of interest at which the contract can happen is 100 minus this, which is 5.85. Point is, you want to borrow for a period of 6 months after 3 months. Future contract is after 3 months, but only for a period of 3 months. Then do you agree that even if I do the hedging, even if I have a gain, hedging, suppose in case of hedging, derivative may give me gain. Derivative give me the gain of only 3 months, whereas in the spot market, I will have a loss of 6 months if there is a loss. In the spot market, there is a loss of 6. The derivative market will hedge, will compensate, but only for 3 months. Now, if I need a compensation for 6 months, do you agree that I will have to double the amount of contract, double the value for which I've been doing the hedging? Yes. So the revised formula become, if your duration of loan is 6 months and if your period of borrowing in contract, period of borrowing in future contract is 3 months, then you should take 1,000 contract if everything is fine. But those 1,000 contracts are only for 3 months, where in the spot market my period of borrowing is 6 months. So into 6 by 3 will double the number of contract as 2,000, so that this you are hedged overall for a period of 6 months. The 3 month can compensated by for 6 months by doubling the number of contract. I hope I could explain it. This is what institute has done here. So please everyone in the class, let me explain. Sir, in the spot market you pay 11.25 and 16.25. Fine, sir. Now in the derivative market, this time I have what? In the derivative market, this time I have a gain on futures to be adjusted. Sir, I entered into a contract to borrow at 5.85. Think like FRA only. I entered into a contract to borrow at 5.85. Rate in the market is 4.5. Do you feel a loss for yourself? Yes. 5.85 minus 4.5. Loss of 1.35. Yes. On what contract size? On 50,000 I have this loss, and the contract is only for a period of 3/12. This is the amount of loss per contract. How many such contracts did you do? You did 2000 contract. You were supposed to do actually only 1000 contract. But contract is for 3 months. I'm repeating it. Contract is for 3 months and my borrowing period of 6 months. So I want 6 months hedging using 3-month contract. I need the compensation of 6 months but using only 3-month contract. So let me double the amount of contract, which is why the contract number of contract is 2000. So rather than people in the class hedging using, if you hedge using 3-month contract for a period of 6 months, you double the number of contract and the amount of compensation, the amount of loss in the derivative will be 337,500. In the spot I pay 11.25, in the derivative I pay 337, overall I pay 1462,500. Even if the rate becomes 6.5, in the spot I pay 16.25, but in the derivative I receive 162,500 because of gain. Overall I pay 1462 in any case. Overall, when I convert it to percentage terms, effectively in percentage sum, I end up paying 5.85% only, which is my agreed futures rate. That is how it has been useful. I have justified. Right? So you have to tell them that you have entered into a contract to borrow for 2000 contracts, and accordingly the adjustment in the derivative is this, spot is this, net is this, and that's what question number 56 was. Main point of learning number 1 for FRA, don't to do the present value of the gain loss, because the objective is not to calculate the settlement amount. The objective is to justify the hedging. Since the spot market interest is 9-month end, let's keep the derivative market gain loss also at 9th month end. That was first learning. Second learning, for futures hedging you have to think like FRA, but for the purpose of calculating number of contract you have to make use of this formula, the logic of which also I have explained. I hope I'm able to convey to you 10 out of 10 question number 56. Next question, people, that we're gonna do in the class. 58 is a brilliant question, you'll have to do at your own. Next question we're gonna do is question number 59th. Come on. 59th, people. Sir, 59th you'll be able to do after learning the another contract in futures. Interest rate future, a contract to buy or sell a bond. This another contract underlying is not an interest rate, is not a contract to borrow lend. The underlying is a bond, it is a contract to buy sell. So suppose I have entered into a contract to sell to you a bond, right? But explaining the story in short, the bond is a notional bond, the bond does not exist in market. Then think of the delivery settlement. For the first time I have to think for the delivery settlement. Sir, what was the delivery settlement? Actually doing what we agreed upon. If I entered into a contract to sell to you this bond, then I have to deliver to you this bond. But the bond is notional, does not exist. So there is a list of the bond. So for example, let me take you to the practical question. There is a list of the bond called as deliverable bond. A stock exchange says you have to sell a bond to him, right, at an agreed price. Suppose that settlement price, that agreed price is 1000. So I have to deliver to him any of these bonds. This is the list of the bond available from the stock exchange called as deliverable bond. Any of this deliverable bond can be delivered. Now, if I deliver to you any of this deliverable bond, then what happens? Sir, when I deliver the bond to you, you pay me a price. How much price will you pay me? The agreed price multiplied by the conversion factor. The agreed price everyone is 1000, but depending upon which bond you deliver, the other party will pay you amount after multiplying it with the conversion factor. So in this question, in this situation, you have to assume a short perspective that I have entered into a contract to sell a bond which is notional. So I have to deliver a bond now. Among the bond, I will choose one. How much price you pay me? This much. But a short perspective, practically what will happen? I have to go to the spot market, buy a bond from the spot market and sell it under the contract to you at whatever is the settlement price multiplied by conversion factor. So as a short, I'll have to go to the spot market to buy the bond. That will be my outflow. Then I will come to you. You are a long, I am a short. I will have to deliver a bond to you. And what is the price I will receive? Whatever is the future settlement price multiplied by the conversion factors, what I will receive from you is my inflow. So I have to test for each of the bonds that when I sell to you at that converted price, which is settlement price into conversion factor, for each of the bond, how much will be my inflow? For each of the bond, how much is the price I have to pay in the spot market as the outflow? And the difference is the gain loss. The bond which gives you the maximum gain or the minimum loss is the best bond to deliver. So my question will be to choose among all these bonds which is the best to deliver, which is the cheapest to deliver. I should deliver to you. The terminology is official. I have to find out the cheapest to deliver bond out of the deliverable bonds under physical delivery. Right? The entire story we have not discussed, but the crux is really important, which we have discussed. Right? So let's understand that crux, people. Let's talk about that crux. Question 59 says in March 20, one second. In March 20, why is that not working? In March 20, you sold interest rate futures underlying notional 7.5% bond. The bond that you entered into a contract to sell a bond, but that is a notional bond. Now you have options, these options which you can deliver against that bond. Sir, when you sell this bond, you will receive 1000 into 1.037. So you will receive 1037. When you sell this bond, you receive 1000 into 0.906, you will receive 906 rupee. When you go to the market, in the spot market, you'll have to buy the bond first to be able to sell. You will have to pay 1037,926 as the prices in the spot market. For every bond, the inflow is there, the outflow is there. Difference is the gain loss. In this bond, I will have a 42 rupee gain as compared to those. This is the best bond. So this is the bond which is cheapest to deliver, should be opted for 6.5%. Sorry, 6.8% Government of India 2029 bond. That was the point. Even I explained the 1 hour story to you. The ultimate crux is this that you will have to do, and which is the solution to this easiest question 59. This completes our discussion even on the futures. Now the next discussion, people in the class, has to be on the swap. Again, the swap, which is really confusing to a lot of students. Let's discuss it with our best clarity in this class. Right? So let's take a quick 2-minute break, post which we will discuss. We might have to take a 5-minute break actually. Fine. So let us take a 5-minute break, then we all continue the discussion. Bye. See you all. Yes, so everyone in the class, there. What we gonna discuss now is swaps. Really interesting. If you understand it well, it's never confusing. So let's see what it says. Swap is actually an agreement to exchange the cash flows. So suppose both of us enter into an agreement where I will say I will pay you some cash flow, you pay me some cash flow. For what period? Overall, during a period of 2 years, we will exchange the cash flow, right? So let's say, for example, nature of the contract is one will pay fixed cash flow, another will pay floating cash flow. Like swap is an agreement between the two parties where the nature of the swap or the terms of the swap is 8% versus 6-month LIBOR flat. What does it mean? Let me explain. It means the party who will pay fixed will pay 8% per annum. The party who will pay floating will pay 6-month LIBOR flat. 6-month LIBOR flat meaning to say, in the market for every 6 month, the 6-month LIBOR gets decided. Yes, sir. That you have to pay flat means only that LIBOR you have to pay, nothing over and above LIBOR you have to pay. Right now, suppose if the duration of the contract is 1 year, suppose the contract is entered for a period of 1 year, then do you people agree? In a period of 1 year, there will be two 6-month LIBOR that gets decided. So at 0 point, when we entered into a contract, suppose we did not know what is the 6-month LIBOR. After entering into a contract, we got to know that the 6-month LIBOR is 9%. The settlement as usual will happen at the end of 6 months, right? Because 6-month LIBOR is applicable for 0 to 6. So obviously the contract has to be settled at the end of 6 months, meaning to say the 6-month LIBOR, which is the reference rate of this contract, automatically gave us the clarity that the settlement has to be semi-annual. At the end of 6 months, what happens? At the end of 6 months, what will happen? Sir, I know that I have to pay you fixed rate because that was the agreement of 8%. And you know you have to pay me whatever is the 6-month LIBOR, which has turned out to be 9%. So I have to pay you 8, you have to pay me 9. So net, is it that you can pay me 1%? Yes. But can you pay me a percent? No, you have to pay me rupee, which is why a notional principle is also agreed upon, that a percentage that will be exchanged will be over a what notional principle? 1 lakh rupee. As the word notional principle is there, you can feel actually I will never pay you 8 or actually you will never pay me 9. It is only a contract to do the net settlement of 1% people in the class. Yes. Net, you will pay me 1%. But do you agree these rates of interest are per annum? Needless to mention, my period of borrowing is only for a period of 6 months. So on my notional principle, whatever is the difference rate, which is fixed minus floating, right, for a period of settlement of 6 months, which is 6 by 12, will get settled at the end of 6 months. Similarly, at the end of 6 month, interest for the next 6 months get decided, which means suppose 7% gets decided. So now at the end of first year, I will have to pay you 8% per annum. You will have to pay me 7% floating rate per annum, but only for a period of 6 months. So again, net, I will pay you 1% this time for a period of 6 months on my notional principle of 1 lakh. That is what the plan is. That is what the plan will be. Are you people understanding it? Meaning to say, in a period of 1 year, swaps can have multiple settlements depending upon the compounding or the settlement frequency. Not compounding frequency, settlement frequency. If the reference rate is 3-month LIBOR, then it gets decided every 3 months. The settlement of fixed versus floating will happen every 3 months, which means 4 times in a year. Sir, next. 8% versus 6-month LIBOR flat means the party who pay fixed will pay 8 and the party who pay floating will pay 6-month LIBOR. But how do you decide the position of that party, sir? The party who pay fixed is considered long, the party who pay floating is considered short. This is how the two parties are decided. How do we calculate the net settlement we have learned? And sir, how do you find that the effective or net interest cost? Which means, sir, do you mean the net of spot and derivative market? Yes. Sir, let's say party A is paying a floating rate of interest LIBOR plus 1 to its bank. This is a spot market. Transaction between party A and its bank. I have to pay to the bank LIBOR plus 1. Now party A enters into party B a derivative contract, a swap contract, which is derivative market, where the agreement is that I will pay you 8, you pay me LIBOR. This is derivative market. So from the point of view of A, what is the net interest cost? I am paying LIBOR plus 1 in the spot. In the derivative market, I am receiving LIBOR. So paying LIBOR plus 1, receiving LIBOR and paying 8%. If you do the net of it, you will effectively end up paying 9% per annum as the effective or net interest cost. Yes. So what have you learned? What a swap agreement is. How is it settled? Right? Calculating the settlement amount, right? And then ultimately also calculating the net interest cost. Perfect. First question of this category, let us solve. But before that, let me explain to you one theoretical thing called as generic swap. Generic swap, also called as coupon swap. Coupon swap or generic swap is the most basic form of swap, which is in which one part is fixed and another is floating. What is the main thing to remember is this. For a particular question, you will have to remember it. Sir, in the fixed, when you calculate the amount of interest to be paid, it is calculated considering 3 by 360 days, basically month basis, 2 divided by 12 or 60 divided by 360 days. But the floating part, which for example you have to pay to me, is calculated using actual number of days divided by 360 days. For that, imagine that in that 6 month, it is 181 days or say 184 days. So 181 or 184, whatever number of days divided by 360 days is how the calculation of floating interest is made. This is the market convention. So as I told you in the day counting rules, generic swap also has a 360-day consideration similar to FRA. Yes, boss? So for a generic swap, this is something you will have to remember, for which the first practical question that we're going to do in the class is question number 64. This question will particularly teach me the settlement and understanding of contract. Suppose a dealer bank quotes generic swap all-in cost 8.2 versus 6-month LIBOR flat, notional principal amount of 1 million, same as for a period of 3 years, reset after every 6 months. Sir, understand the line. A dealer is quoting me a generic swap. I went to the dealer. I told him that I want to enter into a swap. He say it is a generic swap, which means fix will be 360 format. Floating will be actual number of days 360 format. This is what the dealer is saying. Fine. The next dealer is saying the fixed part is 8 or 8.2. The floating part is 6-month LIBOR flat, which means only 6-month LIBOR. It means that, suppose this is a dealer. There are two possibilities. Dealer can pay fixed and dealer can receive fixed. There can be two possibilities. When dealer pay fixed, which means when dealer take long position and when other party takes short position, meaning to say when dealer pay fixed and dealer receive floating, the floating he receive will be 6-month LIBOR flat. But the fix when the dealer pays will be 8%. Dealer will pay a lower fixed. Now suppose there is one more client who wants to take a long position and dealer is taking short position, which means another client will pay fixed, dealer will pay floating. So dealer will pay 6-month LIBOR flat, but the party will have to pay to the dealer 8.2 as fixed. Meaning to say, dealer when receives from any party, he will receive 8.2 fixed, but when he pays to any party, he will pay 8 fixed. In both the case, floating leg will be 6-month LIBOR flat. That is all in cost, meaning to say this difference of 0.2% is the cost which a customer is ultimately bearing and the dealer is ultimately earning. There is no other cost or brokerage or commission other than the difference of this 0.2%. Second interpretation, second learning, 6-month LIBOR flat means floating leg is 6-month LIBOR, gets decided every 6 months, gets settled every 6 months, which is why in a period of 3 years, settled every 6 months, which means total 6 times in a year, in 3 years. Fine. Contract is on a notional principle of 1 million. Sir, interpret the dealer's bank quote. We just interpreted it. Then, if the firm is buying a swap, position is long, this situation client 1, what is the nature of cash flow? Nature is he will pay 8.2 fix, he will receive 6-month LIBOR flat. This is the nature. If the firm is selling a swap, which means you are client 2, what is the nature of swap? I will receive fixed and I will pay floating. Fixed of 8% I will receive, pay 6-month LIBOR as floating. This is the nature of cash flow. You have to simply specify the nature of cash flow. That simple is the question. D part. Calculate semi-annual fixed payment for buyer. If you are this person, how much will you pay semi-annual every 6 months? Sir, 1 million into 8.2% into 6 by 12. 1 million into 8.2 into 6 by 12 is 41,000 you pay. Sir, in the 6-month period from effective date of swap to settlement date comprises of 181 days and the corresponding LIBOR is 5%. What will be the first floating rate payment for the buyer if you are a buyer of the swap? What is the floating rate payment you will receive? Sir, from the buyer's perspective, a buyer always receive the floating for 181 divided by 360 days on 1 million at the rate of 5%. How much will it be? 1 million 5%, 181 days is 25,138. So you pay 41, you receive 25,138. Last part, on the net basis, how much buyer has to pay or receive? The buyer will net pay 15,862 as the amount. Are you people understanding? How does the contract happen? How does the settlement happen? Which are the parties involved? Everything in question number 64 could I explain? Everything in question number 64 could I explain? Sir, that was the first thing. This was the first thing. The next concept I am going to teach you is regarding the construction of swap. Construction of swap. If someone asks you to construct the swap, can you construct it? Sir, why would the two parties enter into a swap? To save the interest cost. But before I teach you that, I want to make you people observe one particular thing. What is that observation? Look at it. Sir, A Limited was paying to its bank a floating rate of L+1. Now the decision is what kind of contract A should enter with B in the derivative market. Should it pay fixed and receive floating, or should it receive fixed and pay floating? What kind of contract should it enter? Common sense. The common sense is when you pay floating in the spot market, then when you pay floating in the spot market, then you would receive floating in the derivative market. What is the logic? Floating you receive, floating you pay, automatically your position gets cancelled, you are kind of hedged, you will net end up paying fixed. You pay L+1. When you receive LIBOR, right, and pay 8% fixed under the contract, net you end up paying 9%. Which means if the market LIBOR increases, you pay higher rate, you receive higher rate, no worry. When the market LIBOR decreases, you pay lower rate, you receive lower rate, no worries. Effectively, you end up converting to fixed, meaning to say, if you take a correct position in the swap, Your spot market floating position can be effectively converted to fixed with the help of swap in the derivative market. Could you understand it? This learning is going to be of great help in the next concept that we do. Sir, let's say there are two companies, rigid and flexible. Both the companies when goes to the market can take both type of loans. They can take a fixed rate loan or floating rate loan. Rigid when it's went to its bank says you can either take 8% loan or you can take L+1 loan in floating. Flexible limited when went to the market, the bank says you can either take 6% loan or you can take L+3 loan as floating. Fine. Sir, when we ask these companies, what is your preference? What is your desired? So they say, rigid limited says that I want to take a fixed loan based on my nature. Similarly, flexible limited, when I ask them what kind of loan you want to take, they say we want to take a floating rate loan. So rigid, when it takes fixed loan, the desired is 8%. Flexible limited, when it takes floating loan, the desired is L+3%. The total cost which they incur to fulfill their desired loan is 8 plus L+3, which is L+11%. Fine. Then I think if I make them borrow otherwise, to the rigid limited, if I make borrow at a floating rate, and to the flexible limited, if I borrow at 6%, the total cost they will end up incurring is only L+7. So my plan is cheaper. Only problem is that it is opposite to what they want. My plan is cheaper. Only problem is they are opposite to what they want. So what do? We first make them borrow opposite to their desire. So what is my actual opposite to desire? For example, in the swap question, if you create this diagram, life will be easy. You first of all mark the two parties, rigid and flexible. You write down their desired position. Rigid want fixed, flexible want floating. But then you write down the actual we will make them do because it is cheaper. Sir, rigid limited actually you will make you borrow at floating. So rigid floating is L+1. So to the bank you actually pay L+1. Flexible, your actual is fixed. We make you borrow at the rate of 6%. To the bank you end up paying 6. It is cheaper. Obviously, it is cheaper. It is L+7, but it is against my desire. Do you agree? With the help of swap, we have learnt with the help of swap, we can convert the positions. Let's try to convert. Apply common sense. Rigid is right now paying floating. In the derivative market, this is my spot market position. In the derivative market, in the swap market, what should it do? Should it pay fixed, receive floating, or should it receive fixed and pay floating? The logic is rigid, which is right now paying floating. If it also receives floating, the situation gets cancelled, which means it should pay fixed. Suppose the examiner says swap terms are given. Sorry, my bad. Rigid, which is paying floating. My bad. I incorrectly opened the wrong. I by mistake opened the wrong page. So rigid, which is paying floating, if it receives floating and pay fixed, its position gets cancelled. The bank says there is a swap contract available as 5.5 versus LIBOR flat. It will not say who should pay what. It will say whosoever pay fixed will pay 5.5 and whosoever pays floating will pay LIBOR. So we got to know rigid should pay 5.5 and receive LIBOR. With the help of swap, are we able to convert their position? Let us check. Rigid is paying L+1. It receives L, it pays 5.5. Effectively, it is paying 6.5. So actual of rigid was floating. But have we brought them to the desired of fixed? Yes, 6.5 has been achieved. Similarly for flexible, you were paying 6. You receive 5.5, you pay L. Effectively, you are paying L+0.5. You have come to your desired of floating. Sir, desired has been achieved and that too at a lower cost. Sir, overall they are paying L+0.7%, sorry, L+7% only if you observe. What is the individual gain? Look at the savings, really is important. Sir, first you created a swap diagram that you found out effective cost, net cost, and then you found out the saving. For example, you will say rigid, if you wish to borrow at fix, you will be able to borrow at 8 at your own, at 8% at your own. However, through my plan where you do otherwise and then you do swap, my plan you are able to borrow at fixed at 6.5. So the cost under desired for you was 8, but through me, the net interest cost you are paying is 6.5. You will end up saving 1.5% per annum as your interest cost on whatever is the amount of borrowing. Similarly, people, are you all there? Similarly, people, sir, flexible. If you go to the bank and borrow at your own plan, at your own wish, it is L plus 3 as your cost. However, when you go through me, when I do you otherwise and do you enter the swap, the effective cost you're paying is only L plus 0.5. So you will also end up saving 2.5, this save 1.5, this save 2.5, the total saving is 4%, which matches with the original saving which I planned for these parties. This is why the two party enter into swap. Similar to this can also happen a currency swap. I hope first of all you're clear, right? First of all, the way is really simple. Both the parties have both the things. But what they want is expensive. What I can do them for is cheap. If what they want is already cheap, if this is their desired which is cheap only, then swap. Why do you do the swap? What is available is already cheaper. Why do you want to make it complicated? We make it complicated because what I want is expensive and what is otherwise available is cheaper. So we borrow at cheap. Do the swap so that we can come to the desired position at that cheaper rate and then finally calculate the gain loss. The common sense is cost at which you could have done it directly, then the net interest cost when you go through us by way of actual plus swap. Actual is opposite to what you wanted, plus swap makes you back to what you wanted. This is the savings then. Now this was fixed versus floating swap. A similar concept is this is interest rate swap, where one party pays some interest, another pays some interest. Another category of swap is currency swap, on which this category question is being asked. I say whether it is fixed versus floating or any kind of currency swap, the underlying logic will remain the same. I will pay you interest in some currency, for example 5% in dollar terms. You pay me some interest, for example 8% in euro terms. That is how the swap will happen. Same logic. Let me take you to a practical question of that. You will automatically understand what it means to say. So let's solve question number 68. 68. Right? And let me open that for you in the handmade notes. Best if I get the thing. 68. Perfect. Perfect. A limit, A incorporation and B incorporation intend to borrow 2 lakh dollar and 2 lakh dollar in yen respectively. A, B. What they desire is dollar and yen respectively. For a time horizon of 1 year, interest rates are below. A can go to the banks to borrow either in yen or in dollar. Yen cost is 5%, dollar cost is 9. What A wants? A wants is dollar marked as desired. B incorporation can also borrow in yen or dollar. When A go to yen, it is 8% cost. A go to dollar, it is 10% cost. Marked as nothing as of now, nothing. Sir, desired total cost is 8 plus 9, 17. Whereas if I make them do otherwise, the actual cost is 15. So this is first of all the validation of swap, that the swap can happen because the actual is cheaper. Let's make them borrow at cheaper rate and convert their swap. Sir, in actual to A limited actual, if we make them borrow at yen 5%, and to B incorporation we make them borrow at dollar 10%. That is what we make them do actually. Through the swap, we will convert them to the actual position, right, to their desired position. But what kind of swap it will be? A will have to be something, pay B something, and B will have to pay to A something, right? Now what happens? Listen to me. Exchange rate is there. They have entered into a swap. Please observe something. Institute will not mention that available was expensive. So first you do otherwise or opposite of your desire. What you desired was expensive. What you desired was expensive. So examiner will not specify that first you borrow opposite to your desire and then you enter into a swap. That is your understanding of the question, that okay, this has happened, which is why they are entering into a swap. And now the swap terms will start. right? Swap term says they entered into a currency swap under which it is agreed that B will pay A Incorporation 1% over the yen loan interest which the later means A Incorporation will have to pay as a result of agreed currency swap. Sir, B will pay to A 1% plus the yen loan interest which A is paying. You must be wondering, sir, A wanted to borrow dollar. Why would A pay yen? Because we have made it borrow other against its desire. That is the point a question will not specify. You will have to understand. So what we say, A will have to pay yen loan interest actually. So B will compensate to a 1% over and above that, which means 5 plus 1 is 6 what B will have to pay, whereas A will reimburse interest to B to the extent of 9%. This is what it will reimburse, keeping exchange rate invariant, ignoring it, quantify the gain loss. With this swap, how much have they gained? How much have they saved for themselves? Sir, A's effective cost is 5 plus 9 minus 6. Effective cost for A is 8%. Effective cost of B is 10 minus 9 plus 6 is 7% effectively. This is what they will effectively pay, and they have come to their desired position with the help of swap. Now let's check how much is the gain. A, when you go to your desire, you borrow dollar at 9, but now you borrow dollar at 8. Are you end up saving 1%? Yes. Similarly, B, you desire at 8 yen, but through us you desire at 7. So are you ending up saving 1%? Again, correct. Both are saving 1%. Now let's convert. An additional thing in the currency swap you will have to do is to convert in the respective desired currency. $2 lakh, 1% is $2,000. $2 lakh in yen terms multiplied by 120, 1% gain is 2,40,000 yen. Convert to their desired original currency the amount of gain, that is question number 68, which was about constructing a swap. That is what we have specifically learned. Constructing a swap, boss, and calculating the gain loss after construction. That is what you have learned. Next level, I will tell you. In this case, you have learned construction. In the next case, you don't have to learn construction, but take the help of this concept. Sir, this time examiner gave you swap details using which you calculated net interest cost, using which we calculated savings. Now examiners say the total saving is 4%, which is fine, which is to be distributed among the parties as this. So then you will back calculate or reverse, then you will have reverse calculated gain, which is there, using which you will have to calculate the net interest cost. So you have the savings with you. You have the cost which would have been incurred if you actually go at your own to borrow at desired rate. So you will have to back calculate the net interest saving, which is extremely easy. I can show it to you through a practical question. The concept is really easy. Total cost under desired minus total cost under savings, gross saving. If there is a commission by the broker, deduct this, you will get net saving to be distributed between the parties like this. So then you will say, if the party go to borrow at its own desire, it is 8%. Party go to borrow rigid at its own desire is 8%. Right? Minus, if it goes through us, the share in the gain is 1.6, it will end up saving 1.6. If it goes at its own, it would have paid 8, but through us it will save 6. So then through us, how much will it be paying? 8 minus 1.6 is equal to, it will end up paying 6.4%. Yes. Similarly, L plus 3 minus 2.4 is L plus 0.6% is what it will have to do. I mean, similarly flexible, if it go at its own, to fulfill its wish, desire, the cost it would have paid is L plus 3. But through us, when it goes, it will end up saving 2.4. So how much will it end up effectively paying? It is L plus 0.6. That simple is the concept, based on which now let me show you a practical question. Let me now show you a practical question, extremely easy. You look at the practical question. The next question we're gonna do is a 62 is a easy question whose advanced question 63 we're gonna do in the class right now. Back calculating the effective interest rate. IF an Indian firm subsidiary in Singapore, SF a firm subsidiary in India, face the following interest rate. IF can borrow in India at a floating rate at BPLR plus 0.5, and it can also borrow at a fixed rate in SGD at 3%. I would say not just the floating fixed has changed, but also currency has changed. When you have an option to solve it using fixed floating, ignore the currency and solve it keeping in mind the fixed floating. BPLR plus 0.5 is the floating rate, fixed is 3 for IF. Similarly, SF has BPLR plus 1.5 plus 3.5. SF wishes to borrow at floating rate. SF floating desired. IF SGD fixed. IF fixed desired. So desired total cost is BPLR plus 4.5. Desired actual, if we make them borrow otherwise, the actual cost is BPLR plus 4. So this is agree that let's make them borrow otherwise. Let them do the swap so that they can borrow at desired ultimately, and that too at a cheaper rate. So let's see. Loan amount required by both is same. Bank arranges a swap, require 50 basis point as commission. So I will do the swap for you, but I will require commission. So you are anyway saving 0.5. Out of that 0.5, if I charge 0.5, what you're left with? 0. And if you are left with 0, how would you distribute it among yourself? No gain distribution. Sir, why would you agree to swap? Won't agree to swap. So it says bank arranges a swap, require 50 basis point, which is to be shared equally. Fine. If requires IF require a minimum gain of 20 and SF require a minimum gain of 10. Sir, it is 0 left with me. Out of which IF require 0.2%, SF require 0.1%, fine, to structure the deal. The bank is very keen to structure the deal even if it has to forego a part of commission. Sir, I initially wanted 0.5. But if I have to forego a part of the commission, even if I have to distribute 0.3 to the other parties, I'm ready to do it. I want to just do this deal. So let me have my commission as only 0.2. So that when 0.3 is left, it can be distributed as this. Sir, first part I will explain to you later. Second part, can the swap be arranged? Yes, we will say 0.5 is the gross gain, 0.2 is the commission, right? And 0.3 is the net gain available to be distributed to both the parties. B part easy. C part. B part, beneficial swap can be arranged. C part, what is the rate of interest they will end up paying? They will end up paying. So we say, if they go to fulfill their desire, it is B plus 1.5 and 3. B plus 1.5 and 3. If they go through us, IF will save 0.2. What is what examiner is saying? IF will save 0.2. SF will save 0.1. So effectively, how much they will end up paying through us under the swap? They will end up paying 2.8 and BPLR plus 1.4. They could have paid minus what they save. They will what end up paying is what the thought is, right? Except for first part of the question, question 63, everyone in the class gets done. I hope I could explain, right? Next part is a bit theoretical in nature to answer, right? In our class, the way you have learnt swap has nothing to do in the practical question or swap creation of this concept. This is just a theory perspective you develop. There are two types of swap, ABC and DEF, right? When they go to fixed market, ABC is able to borrow at 8, DEF at 9. When both of these companies go to floating market, ABC is able to borrow at L plus 3, DEF at L plus 1. If you observe, one company has advantage in one market and another company has advantage in one market. In the fixed market, ABC had advantage. In the floating market, DEF has advantage. This kind of an advantage is called as absolute advantage. When we go another situation, when they go to fixed market, ABC and DF are able to borrow at 8 and 9%. When they go to floating market, ABC and DF are able to borrow at L plus 1 and L plus 3%. Sir, In the fixed market, ABC had advantage. In the floating market, again ABC has advantage. But do you agree? Comparatively, ABC has a higher advantage in the floating market. I mean, there is an advantage to ABC in both the market. But on a comparative basis, sir, here ABC is able to save 1%, but here ABC is able to save 2% as compared to B. The level of advantage is 1% versus 2%. So floating market has comparative more advantage. Is what comparative advantage is. Examiner in this question is asking to you that is there any advantage available to SF and IF? We will say in the floating market IF is cheaper. In the fixed market again IF is cheaper. So IF is more cheaper or has higher advantage in which market? We will say floating, because fixed has only 0.5 difference, floating has 1 difference. So IF has more advantage in the INR floating market. You can think it from SF point of view as well. SF will have to pay extra 1% in the floating and pay extra 0.5% in the fixed. So do you agree? Paying lesser is a better deal. So SF has a comparative advantage in fixed market because it has to pay only 0.5 extra, and that is what we are trying to say, fixed market SF comparative advantage. Are you understanding, everyone in the class? That is question 63 which gets done. So now you are done with understanding the basics of swap. This particular page you are done with. Then next page we did not discuss, is what not needed. Further next page you learned to create a swap. If the swap terms are given, we created a swap, calculated gain loss, all that we have done. In the further next part we have learned to calculate the net or the effective interest cost. This much we have learned in concepts. That's all is needed to solve the practical question. Further part not needed, not needed. Sir, next thing I will teach you is a small thing based on which there is a practical question, overnight index swap, right? Most probably the last question for this video. So let's super fast understand what this is. Sir, in fact currency swap we have learned. Sir, generic swap we have learned, now overnight index swap. What happens? So really simple. I have to pay you fixed, you have to pay me floating. Simple. Difference is the floating that you pay me. What is the underlying reference rate? Underlying reference rate is the overnight rate, meaning to say it is a 1 day LIBOR, 1 day MIBOR. Every day the rate gets changed. Just give me a second. I'm in class. Is it urgent? Yeah. Yeah. So what were we saying? You have to pay me a daily floating rate. So how does the settlement happen? Is it that you pay me floating every day, I pay you fixed every day, and every day we settle? No. What we rather do, that floating part we calculate, which become due every day with the compounding effect. Sir, what do you mean with the compounding effect? I will tell you. So for example, we enter into a day swap for a period of 7 days. So for a period of 7 days, with every day's floating rate, we will keep on calculating interest and we will add it. Using a fixed rate for a period of 7 days, how much I have to pay, that also will be calculated. And then ultimately the net settlement we will do. Only difference is the daily overnight floating rate will get compounded, and this won't be compounded. This will be a simple interest overall rate for a period of 7 days. Sir, what do you mean to say? Let me explain to you that in a practical question. Sir, question 66. There is this bank called as derivative bank, right? Who enter into a plain vanilla swap, meaning to say fixed versus floating, through OIS. One party pay fixed, our other party pay floating overnight on a principal of 10 crore and agreed to receive MIBOR and against a fixed payment. So I will receive floating, my position is clear, I will receive floating, I will pay fixed. The swap was entered on Monday, 2nd August, was to comment on 3rd. Sir, from Tuesday, which is 3rd, the rate for the next 7 days are given to me every day a new rate. A total of 6 rate has been given because 7.98 is the Saturday plus Sunday rate because Sunday is otherwise holiday, no new rate. Fine, sir. Derivative bank received 317 net. What is going on? Derivative bank has to pay fixed, has to receive floating. Sir, what is the rate at which it will receive floating? This is the rate. It will receive floating, fine. When they did the net settlement, it net received 317. So can you back calculate how much fixed it had to pay? Floating you can calculate using the rate. Net it received is this. So how much fixed it would have paid or it had to pay, can you calculate? Yes. And after that also calculate the percentage of fixed. Really a simple question, makes sense. Let's learn how do you calculate the floating part. You have to learn compounding. Sir, Monday closing 10 crore was the principal. First day 7.75% is the rate for a period of 1 day. So 10 crores multiplied by 7.75% for 1 divided by 365 is 21233. For Tuesday, which is my first day, closing principal will be opening plus interest as the closing. Now compounding effect means for Wednesday, which is my second day, rate being 8.15, will be charged not on 10 crore but opening of Wednesday, closing of Tuesday, which is 10 crore 21,233. On this amount, you charge 8.15 for 1 day. So closing of that day with interest become this. Next day, same. Next day, same. Sir, when it is 7.98% rate, you will charge the interest for 2 days, one shot without compounding. Meaning to say Friday's closing multiplied by this rate into 2 divided by 365 you will have to do to find out the interest for Friday and Saturday simultaneously. Sunday will not be calculated on Saturday's compounded rate. It is a typical question. It has logic as well as the element of mug up, frankly saying. What is the element of mug up? The fact that compounding daily happen, the fact that Saturday, Sunday compounding won't happen. So Sunday you won't compound on Saturday's interest. You will directly calculate on Friday's closing the interest for 2 days so that you can find out directly Sunday's closing. Then again Monday closing, the basic work. Every day you have to pay this interest, which is based on interest on interest. The total floating you have to pay is 153,740. Apply common sense. I had to receive 143,740 under floating. And I had to pay something which I don't know. But net I received 317. Can you tell me how much the amount I had to pay? I had to receive 153,740, but I received only 317. So how much I had to pay? Common sense, this minus this will tell you how much I had to pay. So it is 153,423. I had to pay. 153,423. If you have to convert it in percentage terms, so this much I had to pay in a 7 days. So annualized is 365 divided by 7 over a principal of 10 crore. Give me 8% on a rounded off basis at the interest in the fixed leg. So it was a question of overnight index swap, that too with the reverse calculation, which is why I'm calling it as typical. Question 66, I hope I have explained overnight index swap. The next concept I'm explaining related to that is an easy question you will have to do at your own, the concept of equity swap. Yes, equity swap is a kind of swap where one party pay any kind of interest, fixed or floating, other parties pay equity return. It can be return of equity market like Nifty Sensex, it can be return of a particular share or portfolio of equity. So I pay you fixed, you pay me floating. So for example, it is agreed that I will pay you 8% fixed, right? You pay me 5%, you pay me equity. In the first year, equity return was 5. So I will pay you net 3. I pay you 8, you pay me 5, net I pay you 3. In the second year, suppose equity return is 10. So I pay you 8, you pay me 10. So net you will pay me 2. Common sense, logical, basic. Next part. Sir, suppose in the third year equity give you negative 2% return. Can equity fall? Yes, negative 2% return. So I pay you 8 and you pay me -2. So it is like you paying me -2 is equal to I paying you 2 basically. So I will have to pay you 8 as well as -2 you pay me, which is I pay you 2. So overall I have to pay you 10. This is the part different in the equity swap. Yes, except for that, it is all easy. So let me check. We have done all the needed practical question with all the concepts in great detailing. Everything which is needed has been discussed. Interest rate, risk management, every possible topic with every needed question we have discussed with my best in this class. Yes. So that was all from my side. As I say it every time, right? Whenever you're watching this video, if you feel that the questions and concepts or the learnings of this video has helped you, kindly share this with your colleagues, juniors, in your offices, with your friends group. Please do like this video if not yet, and please write down your genuine feedbacks, your genuine comments in the comment section of this video, right? So thank you so much for watching up this video. Let's meet back again in the next video. I have a small doubt here. Sir, Tuesday 7.75, is it? Yeah, 7.75, 7.75, cool. I mean the misprinting, it would be there. The calculation would be correct only. It's just the misprinting of the rate, question solution will be correct only. So next is IFM. We're gonna meet back for IFM day after tomorrow. Yes, thank you so much for watching up this video. Let's meet back again in the next video. Bye people, take care.